Hey, LeAnn.
And today it's going to be, well, sometimes when I dig into financial stuff, it's not always exciting. But I think it'll be exciting today because when we can figure out maybe something new to try, that's always exciting. And if we can certainly uncover a mistake and then correct it, that's exciting because guess what? We might have more money in our pocket. And that makes everybody happy, doesn't it? So I'm excited to have a chat here today with you. And we got 2 more minutes to go so they can see us. Hi, everybody. We're just about getting ready to go live with common real estate investment mistakes to avoid. And today we have Scott Jensen, who is a financial advisor. So hopefully he can point us in the right direction. And then myself, who is a real estate investing expert. So combining those two topics, there's always a lot to learn and it's changing all the time, isn't it, Scott?
Yeah, just about every year they seem to make some sort of adjustment to the tax code and what's allowed and not allowed. So
Exactly. And even this new, with COVID, there's some relief items, that can make a difference for a small business.
right. Small business and or just individuals with the tax changes lately. There's a lot of opportunities depending on what the situation is.
Certainly is. And the other thing is, now there's these PPP loans and idle money, and that all factors into, how it shows up on our bookkeeping this right now and how we use that money to hopefully grow our businesses. That's the point. Yeah.
Right. There's a lot of different relief efforts, and the PPP loan is great for a lot of small businesses, mainly businesses that have had some sort of loss in revenue. The strange thing about the coronavirus and all of the economic fallout is it seems to have hit businesses very differently, right? So some businesses are just really struggling to make ends meet, and other businesses are just flourishing. And so a lot of the relief has been designed to help the struggling businesses, but not all of it. And there are things that businesses can do to take advantage of some of the relief efforts.
There is. So, okay, it's 4 o'clock. So I'm going to say welcome to LeAnn Riley's Real Estate Investing Club. And I just want to say hi today and let you know that I interview expert speakers and leaders in real estate investing nationally. And you get to ask questions and participate from anywhere. And the truth is, you don't need a ton of money or knowledge to get started as a real estate investor. You just need to know the right formulas and you need to follow a system to be a smart investor. So I'm LeAnn Riley, real estate broker and coach, and I lead the Encore investment team of realtors in the Twin Cities, Minnesota. And I built a multi-million-dollar portfolio in residential, multifamily, condo development, commercial, and vacation properties. As a national coach and trainer, I help ambitious people build wealth as real estate investors with my proven profit formula coaching program. And I provide education like this meeting today with my real estate investing club. It's tips and tools and trends and all the latest in real estate investing. So you can check out my YouTube channel if you miss the interviews, and they're over there. And it's just under LeAnn Riley. So I'm really glad you're here today to discuss the common real estate investment mistakes to avoid. And today, our guest is Scott Jensen, and he's a financial advisor who specializes in working with real estate investors. That's how come I found him. And he's combined his career of financial planning with his hobby of real estate investing at Renovate Financial Planning. And Scott helps his clients plan a long-term strategy with expert professional guidance in real estate and the stock market. So I've got a lot of questions for him today, and then we'll go through how you can ask also. And let's learn about those big mistakes we need to avoid. And I want to know how to build a smart portfolio. So hi, Scott. We're really glad to have you as our guest today.
Thanks, LeAnn. I'm excited to be here. Yeah, I think there's a lot of good stuff to talk about. So let's get started.
There is. So I always like to share how I met our speaker, because real estate investing is all about networking. And we first met last year when I kept seeing his name pop up, people recommending him in some Facebook groups, and I just kept seeing it pop up. So then, of course, I started researching, who is this guy? And I noticed he was a certified financial planner. And, you know, often I see a gap with financial advisors who aren't always on the real estate. They don't know maybe about the real estate, and they're more in the stock market. And it's hard to find one that gets real estate at the same time or at the same level and can help us balance that out. So when I found Scott, we got together and got to know each other. And I really think it's good to have someone who is balanced, you know, and understands there's different ways to go at helping us grow our finances. So I was curious. So now I'm sharing, you know, with you. So give us a background about what led you to real estate in the first place, Scott.
Sure. Well, I've always been interested in real estate, in business, finance, money, how people handle money, and just investing in general. And then in 2011, after the housing crash, my wife and I bought our first house, and it was a nice little property, but it was a foreclosure, and it had been vacant for a while, and it definitely needed a bit of work, right? And so this was my introduction to swinging a hammer and replacing things and fixing things up, and just kind of learning what it is to own a property. And so that went well, and my wife and I found that we enjoy working on projects together, which is super helpful. So we bought that house, and we fixed it up quite a bit, and then finished college, and our family grew to the point where this small little house we were living in was a little too small, and my wife was pregnant with our third kid, and we realized when the kid was born, we wouldn't really all even fit around the dinner table. So we decided it was time to move. And we were trying to sell the house, but we were tossing the idea around of renting it out as well, because we'd always been interested. And I do think that is a great way for people to get started, is to move and to rent out your current home. But so we moved into a larger house that we could all fit in comfortably, and then turned the first house into a rental property. And that went really well. And so we enjoyed it. And from there, we added another unit in our current house. And then just this last, 2 springs ago in 2019, we did another, not a flip, but like a BRRRR, where you buy a property and fix it up and rent it out and do the whole delayed financing strategy. But so, yeah, that's kind of how we got into it.
Cool. So yeah, and that is a good way, because you had some equity in that first home when you moved on to the next one. We already have a question here from Ravi about EIDL loans. Can you answer that? Can you see it there in the read it out loud?
So EIDL loans, it's all very specific nowadays, and they changed the requirements. So the EIDL loan is a SBA grant, Small Business Administration. Well, not grant, it's a grant and or loan, but they changed the requirements so that you can only get it if you are in a certain location that qualifies as a low income area. And so I would recommend looking at the Small Business Administration's website, because if you are in an area like that, you may be eligible. I know the properties I'm at, we do not qualify.
Ah, you're in suburban locations, correct?
Right. Yep. I've got a property in Coon Rapids, Minnesota, and Lime Lakes, Minnesota.
Okay, yeah, and he says all of his properties are rented to low-income people, Section 8, if I'm not mistaken. So
So
that could qualify, and I would check with your, just look it up. Yeah, Section 8, he says, look it up through the EIDL loan process. But you know where the other place I've gotten great help is my banker.
mhm.
He's been wonderful at helping me figure out what would and wouldn't work, because did you know, real estate agents are eligible too, because we're independent contractors and we're eligible for PPP loans.
Yeah, most small business owners are, and I know right off the bat, the original EIDL loan or EIDL grant was available to everybody who had some sort of economic impact to them.
Yeah.
Since then, the newer versions have been restricted a bit, and so they've tightened up some of those lending and grants. But it's still worth checking out. The banks are the ones that process the PPP loans. The Small Business Administration themselves process the EIDL grants and EIDL loans. But most of the time, the bankers do have a pretty good understanding of both. It is a good example of an area in which it's helpful to have a small bank or a credit union as opposed to one of the larger banks.
Yeah, you have somebody you can talk to.
Right.
Yeah. Okay, so then, just logistically, I want to say, I like to take a poll at the beginning. Let me pull up my poll. I just want to see who's here listening. This will just take a second. So I launched a poll here, and all of you who are here, you vote here. Which one are you? Are you just getting started in real estate investing? Are you a fix and flipper, buy and holder? I want to see who's listening here today to make sure we talk to you. Okay, they're voting. Oh, right now, buy and holders are winning. That scaling one is off my screen, but it says 19%. Okay, looks like the buy and hold. I'm going to end the poll here. If you didn't vote, quick do. And here's the results, everybody. Buy and hold. That's who's on this call. And, that makes sense, because guess what? That's, I teach buy and hold, and that's where it's ultimately the place to get, because, let's see, there we stop share results. Okay, do I got that off? Yeah. All right, we're back to looking at Scott and I. So that's good to know. Buy and hold, it's all about passive income. That's why we want to do real estate, right?
Right.
So,
That's definitely the most tax advantageous type of real estate as well.
Exactly. So just know that, put your questions in that chat box. There is a Q&A section too. I'll keep my eye on it, but we work pretty well out of the chat box. Okay, Scott, first to start off, can you explain the difference between a financial planner and then the traditional financial broker? Help us out there.
Yeah, so the terminology is confusing. And so the term financial advisor, for example, seems to be thrown around by all sorts of people. You've got insurance professionals that go by financial advisor. You have stock brokers who buy and sell stocks on someone's behalf that often go as financial advisor. The term is very loosely regulated. And then there's been some efforts to kind of strengthen that up legislatively, but they haven't gotten real far. But so there's insurance folks that are financial advisors. There's stock brokers who just buy and sell investments that are financial advisors. To me, if you're looking at a financial planner, or otherwise they can be known as a wealth manager, what they do is take a comprehensive look at things. And so whereas a stockbroker is looking at your stocks and an insurance person is looking at your insurance, a financial planner or a wealth manager, what they're doing is looking at the overall situation, trying to determine with you what are your goals, what are the best ways that you can reach your goals, as well as just taking a look at the broader picture of things, and that includes investments, employee benefits. Do you have the right types of insurance? Are you missing any sort of risks? What does your estate plan look like? And then how are you doing things in a way that's long-term going to be the most tax efficient? As well as developing retirement income is usually a large goal most clients have.
Okay, are some, so basically you're a certified financial planner, right?
Right,
So
and so
licensed.
yeah, and so that's a good. There's also a myriad of 3 letters that you'll see after people's names. CFP, Certified Financial Planner, is a really legitimate financial planning designation. I think it's the beginning point of any actual financial advisor who does planning work, right? And so it's a rigorous designation. Usually takes a couple years to get. There's a series of 6 examinations that are each a couple hours long, and then a cumulative exam at the end, and then a couple of years of work history, working directly under a financial advisor. So it's a rigorous designation, and it gives somebody the overall framework to know the basics of financial planning.
Okay, all right. And not every, so this is kind of good to know. Like you say, especially in real estate, the biggest pet peeve I have is when we come up against the problem and someone says, well, check with your accountant, and besides that, check with your financial advisor and your insurance guy. And then I got to call, 4 people, and then I get 4 opinions, and then I don't know what I'm supposed to do. So it sounds like you're kind of all that wrapped together so I could get a bigger picture look.
Yeah, it's kind of a good analogy that ties back to real estate. Is we're kind of like the general contractor of somebody's finances, right? And so we'll be able to recommend specialists just like a general contractor does, but they may have some work that they provide themselves. A lot of times financial advisors will do the investment management, but they may hire out the insurance, they may hire out the estate planning or the tax planning, or different aspects. But financial planners are typically the ones working with a client to make sure we have everybody on the team working towards the client's goals.
That's great. Okay, so now I want to hear about these common mistakes investors make so that we can shore up if we're doing them.
Yeah, and so there's a myriad of mistakes, right? And I've made them, and you've made them, and I'm sure lots of people on the call have made them. The first one, the most common one I see, is making or just not having a solid plan, right? And so you can say this from an individual perspective, not having a financial plan that covers just the overall picture of insurance, investing, risk management, estate planning, tax planning, but also going into a property or an investment without a plan. Just seeing the price on the MLS or maybe from a wholesaler or something, it looks like it'll work. So you buy it and you renovate it and you put a tenant in there, and then you hope for the best. We're really, that's the backwards way of doing it. You should look at, what the numbers are, and then once you understand the numbers, then you can tell if this property fits the criteria. And so going into things without a plan is probably the most common mistake that I see.
Absolutely, especially in investing. You're right. There's something, and some people, there's something about that. They buy that first one and then it doesn't turn out how they thought it was going to turn out. And then they're like, whoa, what happened here?
Right. And real estate investing, it's like baseball, in that it's not about getting a home run property every time, but you need a good solid base hit, right? And so you can't continue to get foul balls or strike out, but you have to have a reasonably good property, a series of reasonably good properties if you want it to work well. And you'll get a few home runs if you do, enough of them.
Yeah, that's true. And you're right. Trying to get the home run every time, that is tricky, especially take today's market. It's tough, but people who are buy and holders, as long as you got something solid, it adds up over time.
Right. And if you're just continually buying houses, right? So if you buy a house every year or every couple of years, or property every couple of years, you're not going to buy them all at the bottom of the market. You're not going to buy them all at the top of the market. You're going to get the average. And over time, the average can turn out quite wonderfully.
That's a good one. So I think you're absolutely right. Without a plan, a lot of stuff can happen that you had no idea. With the plan, hopefully you can decide before you buy it that, oh, that wasn't a good one. Phew, dodged a bullet, right?
Right, right. Or even help you manage what sort of rehab costs or what sort of rehab projects to take on, right?
Yeah.
Yeah.
You don't necessarily have to do it all if it's a rental.
Right, and you don't have to do it all right away. It is nice to get as much done as you can before getting a tenant in the property, but you don't have to do everything right away.
So if someone comes to you and they obviously, they had all these pieces, can you help them like bring it all together and close the gaps?
Right, that's probably the main thing we do. A lot of times people that come to me, they've got, maybe they've had a will drafted, and then they've had somebody else do some estate planning, and then they've got Social Security in the background coming in a few years maybe, and they've got these retirement accounts and some rental properties, but they just don't know how it all fits together, right? Because nobody's looked at the whole picture. And so that's where I come in and look at the whole picture, and talk about the client's goals, and then from there we can say, okay, well, these are the areas we need to concentrate on, and these are how you'd optimize things from a tax and investment standpoint, and just go from there.
And it fits a lot with what I do with my proof and profit formula. It's about figuring out your real estate strategy, and it might have some fix and flip in it and some buy and hold. But if you start going off on 4 other strategies, it's hard to get the plan to work. But if you got a couple, if you know where you're going, it's easier to get there.
Right. It's about setting an investment criteria, and it doesn't have to be the same criteria as anyone else. It's your investment criteria, and it's what you specialize in working with.
Okay. And the next mistake is making emotional decisions. I know where that shows up in real estate. Somebody, I love this kitchen, let's buy this one. Well, a rental property is not about an emotional thing, but where does it show up for you around the finances?
Yeah, and so rental properties, it obviously shows up. Buying a property is a hugely emotional situation, and then being a landlord too, dealing with tenants that are maybe struggling, or trying to balance out being a friendly landlord versus being your tenant's friend, and sometimes it's hard to cross that line, or to stay on the other side of that line rather. And then the other thing is just with stock market investing. Usually doing the right thing in the stock market feels wrong almost all of the time, because when stocks go up in general, the right thing to do is to sell them because you're selling high. When stocks go down, the right thing to do is buy them, right? And that just feels horrible every time. And I've been doing this for a long time, and it still feels horrible because you're putting money into things that have done poorly, and you're taking money out of things that have done well. But that's the only way to, over the long term, buy low and sell high.
But emotions can get in the way of that, is what you're saying.
Right. It just doesn't feel good. And I think real estate investing, you can fall into that too when the market's doing poorly, or you've had a situation with a tenant. It doesn't always feel good, right? It's just how it is.
Well, and people right now are like, oh, I'm not buying right now. Prices are too high. There's a lot of reasons, but there's always a good deal out there. That's what I know. You just have to know what you're looking for.
Right, and you can be picky, right? You don't need to flex your criteria too much or bend too much, but just be diligent and understand too, with interest rates the way they are. Talk to a good mortgage person. You can buy more of a house and still pay the same amount because interest rates are so low.
I know. And just think, if you can lock that in for 30 years, japers, you
Right.
know, you can't lock in the return on that stock investment for 30 years in the same way you can on that real estate house.
Yeah, with the debt portion of it. Yeah,
Yeah.
you cannot. Uh, Congress, the government subsidizes real estate investing in that they subsidize the lending process, and they make it very favorable for investors and homeowners to borrow against houses. And so you get uh, under what would be market interest
Yeah.
rate because of that.
Okay. And now the third mistake, what is it?
Being too risky or being too conservative. And so being too risky shows up oftentimes when the market crashes, or when tenants are not able to, or when tenants are able to legally not pay the rent, say in an eviction moratorium. And so not having enough cash reserves, or not having enough liquidity, which just means investments that you can get at and use. Real estate's a great investment, but it's not very liquid.
Right.
It takes a little while to sell a house and get the money out of it. And you can refinance, but even that takes a while to do and can be costly. And so having other assets off to the side that you can get to in an emergency situation, either be an emergency fund, even sometimes lines of credit, or other assets that you can borrow against.
And then, the being too conservative. Conservative people they never pull the trigger on the deal. I mean, I've run my real estate club for years, and we call them tire kickers. They show up to all the meetings, they learn all the education, but they never pull the trigger.
Right. You've got to pull the trigger. You can do it conservatively, have enough reserves set aside, do the math on the property and see what works. You've got your proven profit formula, but you've got to actually pull the trigger. The other mistake, and this is a sort of controversial one, but in this market, really, do you want to pay extra on a rental property mortgage or your own personal mortgage if the interest rates are this low? I have trouble believing that that's the best spot to allocate money, but oftentimes conservative investors will try and pay off the properties ahead of schedule instead of taking advantage of Congress's and the law's favorable lending terms that you get with real estate.
That is, I love that topic, because it's sort of an American ingrained thing. Pay off your mortgage, just pay it off and then you'll be free. But if you're a smart investor, that is not usually the answer.
Yeah, usually I help, and I see Tim Swierzik wrote.
Oh, he's on here. Oh, he loves that too. Yeah.
Tim's been on your show here, but he's a great mortgage guy in the city.
Yes, he is.
Yeah, it's typically, if you analyze a property, you should analyze a property, both the return on investment and the return on asset. And so return on assets takes into account how well did the property do without considering the financing. And then you compare that to, well, how did the property do with it being financed? And from there you can tell whether it's worth it to leverage up and to have more of a mortgage or not, and balance that out with risk and cash flow. But I think it rarely makes sense to be paying extra on mortgage in this current low interest rate amount, unless you haven't refinanced. Maybe that's a reasonable reason.
But when I go to my financial planner, they always give me this little quiz about how risk averse are you, or how, that's kind of, is that what you use? Is this little quiz?
So I do use that as sort of a baseline for stock market investing, but not so much with real estate. And those quizzes, I've looked at probably dozens of them, and I haven't found one that I really like. But they can be a reasonable baseline and just a good discussion points essentially to help gauge how aggressive or conservative somebody is.
And it's I know what you're saying. It's hard to because I believe in diversification, and so there's some in the stock market and some in real estate, but I tend to not look once I don't even look at my stock statements because I bought for the long haul.
Right, and that's overall the way to do the best. Investing in the stock market isn't something where fiddling and fine tuning usually pays off. The stock market's not something you can guess when it will go up or down. You can't, sell it at the top and wait until the bottom and buy it at the bottom. You'd have to be right twice there, right? You'd have to be right when you sell it, and then you'd have to be right when you buy it. And in actuality, that just doesn't happen for most everybody that tries it, and certainly anybody that tries it consistently can't time the market.
Yeah. So, so basically you're going to sit down with the customer, figure out where they're at, take a look at what they have, and that sort of tells what their risk level is.
Yeah. And the other thing to keep in mind with risk is there's two components of it. One is just how do you feel about making these investments? Is this an investment you can make and still sleep well at night? Because overall, the goal isn't for you to be a gazillionaire. The goal is for you to enjoy your life a lot of the time. And so how aggressive do you want to be just from an emotional standpoint? The other thing to think of is when do you need the money, right? Because investments perform differently. And the stock market is a wildly volatile investment. And so if you need the money anytime soon, well, the stock market's a terrible place to put it. But if you've got years and years and years, the stock market has shown consistently over long periods of time to produce pretty solid returns.
Okay, and then now we got a couple questions. There's somebody here, I pasted it in. Is there a specific percent of the rent or dollar amount you recommend to your clients to budget for reserves in this current environment?
So there's not, and I think everybody's situation is different, and so when it comes to reserves, it's sort of more complicated than you'd assume because you should take into account things like how much are you spending each month? What's your excess that's coming in? How are your different revenue streams? If all of your revenue, let's say, is tied up in a few Airbnb properties, well, maybe you need to have a lot of reserves. And I can't really give you a percentage there, but say you need to have 6 months or so just on the properties to make that work. Whereas if you've got a husband and wife, two reasonably good paying jobs, several different properties, maybe you can get by with less reserves. And also, what other assets do you have? And they don't have to be cash reserves, but do you have some less volatile things in the stock market? Do you have lines of credit available? Do you have a home equity loan or a home equity line of credit that you could tap? And so the reserves question, I don't really have a simple answer for it. It just really depends on all the various factors for someone's situation.
Okay, now we're going to get into number 4 of these common mistakes, which is?
So not understanding investments, and it's investing in real estate as well as investing in the stock market or really anything else, small businesses, the details really matter, right? And so if you refinance your primary residence and then plan to move out the next week and turn your primary residence into an investment property, you missed a pretty big detail, right? Because the occupancy clause. You said when you refinanced it that you were going to live in there for a specified period of time. If you move, that's a good chance that that's considered mortgage fraud, and they do catch people for doing that sort of thing, and the fines are not worth it. And so not understanding the details, which I think oftentimes comes from not working with people who know what they're talking about, and running the situation by somebody who knows what they're talking about. And so before you do some crazy financing deal, let's talk to a mortgage person who knows what they're talking about. before you structure some crazy legal structure, let's talk to an attorney that knows what they're talking about. Same thing with taxes, talk to your CPA or for the overall strategy, financial advisor, right?
Yeah, I think that's critical, and that somebody here is writing a question about a LLC. I don't know that I don't know the answer. Do you know the answer? Something about,
Well,
it's a mortgage question, isn't it?
I don't think that's correct. I would ask Tim to put a brief
Yeah,
answer in the
Tim,
chat.
can you see that in our chat? Maybe you can answer it.
I'm
Tim is a
looking
mortgage person, and this is a mortgage question about what kind of there. Oh, Tim can't see it. It
Here,
says,
I'll read it to you, Tim. It says, I'm looking to move my rentals from my name to an LLC. For financing, I've been told that a 5-1 arm is all that is allowed for investment loans right now. Is this a bank specific thing? I would say yes and no. So if it's a portfolio loan and that the lender, the bank is holding the loan, they've got a lot of flexibility in how they're going to do that.
oh, we got Tim's answer. If it's a Fannie Mae loan, it can be done legally. So you better grab Tim's name out of the chat box and give him a call because he knows the details.
Right.
So
exactly.
I love, it's exactly what you just said, Scott. Find that, you need this team of people that can answer the questions you have so things can be done in the right sequence.
Right, because those little details really matter, and I see them screwed up all the time, and it can be, yeah, it can be a disaster.
Oh, it says chat is not shared, but I swear I set it up to all panelists and attendees. Let's see here.
Okay. There's Tim's order.
I'm trying to figure it out here. Let's see. Save chat.
So we posted that. Was that Tim? Yeah. So the mortgage servicing guidelines for Fannie Mae and Freddie Mac say that you can switch residential owned property into an LLC if you follow the rules correctly. And so it seems to be a very common misunderstanding about owning properties in an LLC, but it can be done. The trick is to just work with a good mortgage person who understands it, and then also be aware of the loan servicing guidelines if that's the loan that you're looking for. So what kind of loan do you have, and what kind of loan are you, or how are you trying to switch it? Okay,
good. All you guys in the chat box, yeah, you have to change your setting to all panelists and attendees because then you can see it. Somebody figured it out. Now I'm getting back to us. We got number 5 of these common mistakes.
And so this one is just the most common for, I think, well, a lot of people, is not getting started or just waiting too long, right? And so no matter what income level you're at, you can always save some. If you're living off of 100% of the income coming in, you can live off of 95, right? And if not, you really need to address your income and expenses and make some changes. And so everybody can start saving some. And if you can start saving some, you can start investing some. And if you can start investing some, eventually it grows into something that you can do larger real estate deals or partner in smaller real estate deals. And there are strategies you can use, house hacking or the nomad type strategy where you buy a house, live in it for a while, fix it up, rent it out, and then move on to the next one. There are strategies you can do without a ton of cash down. But really, I do think as a real estate investor, you should be good with your expenses and manage things wisely, and probably have a fair amount of cash and or liquid assets on the side.
I would think that too. I know for myself, even I didn't know quite when do I need this financial planner? Like, oh, I don't quite have enough money. They won't want me. I don't have $100,000 to invest right now, over in the stock market. So they don't want to work with me. And I found, once I busted that myth, you can start much sooner than that to get that plan coordinated. Is that correct?
Yeah, and it's kind of like waiting until you're healthy to see a doctor, right? It just doesn't make sense. But but it's something typically people want to do, and sometimes they're embarrassed that they've maybe done some things wrong, or they feel like they're behind, and so they're hesitant to reach out. And so financial advisors are compensated in a lot of different ways. One way is by managing somebody's investments, and then the other way is just hourly and or a fixed fee. And so if you don't have a lot of investable assets for a financial advisor to manage and you want to talk to somebody, you just need to find somebody that works on an hourly basis. And for somebody who's in that sort of situation where they're just getting started out, especially, there are advisors that specializes in working with people who don't have a ton of assets to start.
So shop around. And the waiting too long, yes, we know there's analysis paralysis and the not get started, but it really, I get calls and strategy sessions with people who are like, okay, I'm just going to quit my W-2 job. And now I'm finally going to get into retirement. So now I want to be an investor. And I'm like, whoa, don't quit the job yet. Like, let's get a couple under your belt while you are financeable here. And they don't realize that suddenly they're crossing over to the other side that is going to make it difficult to grow a portfolio. We should have been working on this already. So
right.
that can get you.
One of those details that you, if you miss it, it's a big deal. Right?
It's a big deal. So, okay. So what you told us is we don't need a certain amount of money, then, we can go to a different type of a financial planner. It's same thing as real estate. A lot of people think, well, I don't have my 100,000 to get started with. You don't need that always. You just need to find out the details, and then there's maybe a strategy that will work for you. So what would you say? How much money does it take to get in?
So for real estate or for a
financial planning, like how much money do we need?
So it depends on the compensation. A lot of times, if it is a firm that's solely stock market investment focused, they will have minimums. And so depending on the firm, that could be smaller minimums of around maybe 200,000. It could be higher minimums like $1 million, depending on the firm. But other firms, that's become a lot more popular within the last 5 to 10 years, will charge a flat fee. And so it doesn't matter what asset you have, as long as you have the income to pay a fee, and the advisor can provide enough value to you that their service is worth the fee. You don't really need to have anything in the stock market or any investable assets. And so depending on the situation, I know I've come across people who have pretty complex situations, but they don't have a lot in the stock market. It doesn't mean they can't work with an advisor. It just means they can't work with an advisor that's only, making money based on the stock market.
Well, that's where the whole financial plan makes a difference. And, planning for your family, like that's all part of it. It's like having the will and all that. So what would be a precaution about investing, that you might say today?
Right. And so I would say that the biggest one, and you hear it in the disclaimers, is that past performance does not predict future results. And that's after there's those commercials on TV, you'll hear that really fast at the bottom, and it'll have it written out there. But it's true. And so the stock market is a very long-term game, and things go in cycles. And so like more recently, large US stocks have done the best out of anything in the world for years and years and years. And so people look at that and think, okay, well, I'll just put all my money in the S&P 500, since that's a large US company fund, and then things will be great, and that'll do the best. And with the stock market, that's not how it works. Sometimes large US stocks do the best, sometimes it's small stocks, sometimes it's commercial real estate, sometimes it's international. And so having a mix of everything and not making your decisions based solely on the most recent performance. Having a small window, like looking, what is the stocks, what is this asset class done over the last year or a couple years, is way too small of a measuring stick. It's how are these done over 20-year periods, and not just this last 20-year period, but every 20-year period over the last 100 or so years. And so doing that type of analysis is more beneficial than looking at what has something done recently.
Is there a standard portfolio breakout, like okay, you should be in 50% stocks, 50% real estate, do you have a little grid graph thing?
So I say this depends 100% on a client situation and what they want, right? And so real estate's a small business. You and I are small business owners, and that we manage these properties like a small business. And so if you want to manage a large real estate small business, maybe a couple multifamily properties, maybe lots of large multifamily properties, then you're probably going to be mainly invested in real estate. If you just want to own a couple single family houses, you may be mainly invested in the stock market. It depends on what your goals are. But there is ways to do both of them well. Yeah, stocks and real estate go quite nicely together.
Okay, and what if someone knows real estate better and they're afraid of stocks because their knowledge is over there in the real estate world? Then are you going to just like work with them and help them over in that side, or kind of take a look at the big picture and just make sure it's safe? Is that kind of what your job as the planner is?
Right, and so a lot of it comes down to education, because you think even for a real estate investor, we're comfortable with real estate, but we weren't comfortable with real estate when we started, right? It takes an amount of learning and working with people and managing tenants and solving problems before you become comfortable with it. And the stock market's the same way. It does take some experience, and it does take working with people who know what they're talking about and have been doing this for a while in order to do it in a way that works and helps people understand how the market works. The main thing I see is people that are expecting the stock market to produce consistent returns. And the stock market's incredibly volatile over the short term. It's gone down. It went down 30-some%, just not this March, but the prior March with COVID, right? And that was all in like a month. And so that's what you can expect with stocks. In the short term, they can go down like that. But in the long term, they do well. So stocks are a long-term investment.
Okay, I've asked my planner this. What if I follow your plan and it starts to go south? Are you keeping track and watching for me and letting me know when to modify?
Right, and so that's the problem with sometimes people want to do a one-time only plan with a financial advisor, and that's not necessarily wrong, but things change all the time, right? You get a promotion, you have a kid, you get laid off, you inherit some property or an investment, and plans change all the time. So that's what we do as financial advisors, is meet usually a couple times a year to go through your situation and get an update and make sure that we're still on track and doing things the best way possible. Because we're always adjusting and we're always modifying, because nothing ever goes to the plan. And then the taxes change every year or two. And so you've got to continue to look and say, okay, is this still the most tax efficient way to do things? Or are there other things we can take advantage of?
So you're keeping an eye on it if they're a regular client. If they come for a one-timer, like you say, and get the plan and run off and you never see them again, you can't help, right?
And that's the downside of the one-time plan. And the unfortunate thing is you don't know what you don't know. And so most of the time the client doesn't know what has changed, and that it would be beneficial to change things up or to come see you. And so really it's the proactive, ongoing planning where most of the value is.
Okay. And okay, let's see here. Are you helping me with 1031 tax exchanges and real estate investment trusts and Delaware statutory trust? Like, do you do that part of, real estate investing?
Yeah, and so the big benefit of real estate, or one of the big benefits, is the tax benefit, right? And so as you collect rent, a lot of it is tax deferred, But when you sell a property, there's oftentimes a humongous tax bill, and it's all in one year. And with how the tax code works, that can be detrimental. In fact, sometimes it can get rid of all of the tax benefits you've been receiving. And so uh, just paying attention to when clients sell properties and making sure we do it in the most tax efficient way. And so if a client wants to sell something, or if we've looked and said this doesn't seem like it's providing as good of returns as we would want, so let's sell it, let's 1031 it into another property, or maybe into several properties. Or if somebody wants more of a passive investment, you can use a Delaware statutory trust, a DST, which is a commercial investment. And so oftentimes these are professionally managed, either sometimes it's large multifamily, sometimes it's like hospitals, sometimes senior living. There's a lot of different types of these, but it's a professionally managed investment that you can 1031, so you can exchange like a single family rental or a multifamily into this, and it's a passive investment. And so I do help with that as well.
Okay.
And there are other things too you can do to mitigate taxes when you sell a property. I mean, charitable contributions can make a huge difference, or just timing your retirement contributions differently. Yeah, I know I saved a client just this last year over $10,000 when they sold a property, just by changing the way they were doing their charitable giving, as well as changing the timing of the retirement contributions. And so that wasn't deferring taxes like 1031 does. That was eliminating taxes. And so just being mindful of the ongoing planning.
I like that one. Creative tax strategies. We like that. I read something about stimulus fund strategies, and it actually had three, it was different financial planner. He said, like you can get rid of the taxes with HSAs, that's health savings plans, right?
Yep, health savings.
Or put some money in your Roth at a certain time. This is all timing related, right? Or indexed universal life policies. Like that might be what you could help people with too, if you looked at their plan.
Right. And so anytime that you come upon an influx of cash that you didn't expect, and so that can be from the stimulus plans, maybe the EIDL grant, or an inheritance or a bonus. Anytime you come up with a sudden lump of money, there's opportunities and to manage things a little different than you usually do. And so oftentimes, if you hadn't been before, the health savings account's a fantastic option. You get a tax deduction for when you put the money in. You also can take the money out for medical expenses, and the growth on that's tax-free. It can be invested just like a regular investment account. And so those can be hugely advantageous. And then Roth IRAs and 401ks, there's all sorts of different.
There is so many strategies, and I see Craig Wanamaker's on here today too, and he specializes in cost segregation. Another way in real estate to save on your taxes. There's so many strategies, you guys. You got to be connected to the people who know how to employ them, people like you and several of them on here. So
the thing to remember too is real estate is a specialty, right? And so you don't want if real estate is a large part of how you manage your life, right? If you have a large real estate portfolio, real estate's important to you. You don't want a mortgage person that's your friend from college and they're a general mortgage person. You don't want a realtor who's a friend of a friend that sells a few houses. You don't want a financial advisor who's a generalist. You want everybody to specialize in real estate investing. And so there's folks like LeAnn, Tim Swierczyk, myself, just folks that specialize in this area because they're going to be able to provide better service in the thing that you need.
Definitely. And if there's one piece of wisdom you've learned over the years in the biz, what would that be?
One piece. I would say one non-intuitive thing that people don't understand oftentimes is the longer you hold a property, the the lower your rate of return often gets. And so the tricky part is you're managing the trade-off between cash flow and rate of return. And so usually when you start a property, you buy a property, you run the numbers, everything looks good. It's got, maybe a little bit of cash flow, but not a ton. But the rate of return is really good. Rate of return is the measure of how well the equity does. It's the best measure for what's your long-term growth going to be. And so that's at odds with the amount of cash flow most of the time. And so that's where you see people paying off mortgages early. What it does is it hurts their long-term prospect for growth. And so just being mindful to look at your properties and don't just run the numbers when you buy them, but run the numbers continually. I do it once a year for all the clients. We go through and we look at every single property and say, how did they do with the mortgage? And then how would they have done without the mortgage? And we compare it and see, does this still fit in your portfolio, right? And so running the numbers over and over for everything is just sort of a necessity.
It is. It really is. That's how you can leverage them the most and at the right times and grow your portfolio too. So I'm right with you there. Somebody said many folks talk about the 1% or 2% rule when assessing smaller multifamily. If you're familiar with that, how reliable do you think this is? Well, I would say, okay, it's the good first, you do it in your head when you're looking at the price, but it's not really a reliable rule. It's just a little marker is kind of how I call it.
It's kind of helpful, right? Like if
Yeah.
I don't think I've seen anything near 2% for quite some time, but 1% is still kind of a reasonable number. You look at it and say, oh, okay, rents are 1% of the value of the home. That's the 1% rule. So this might be a pretty good investment. And then from there, you can look at the numbers. And really with rental properties, the returns are based off of three, maybe four things, but it's the cash flow, right? The rent's coming in compared to your expenses. It's the mortgage getting paid down. It's the property going up in value. It's property appreciating. And then as the fourth one, you can sort of throw the tax benefits in there. Why I say sort of for the tax benefits is because if you sell the property and you don't manage the taxes, then actually the rental property taxation isn't a good thing for you. It can end up worse. And so, but sometimes you can manage it and it turns out better. So it's sort of a benefit. And the 1% rule is a good measure, just a good easy measure for cash flow.
It is a good, easy, quick measure, but it's not always true in the sense of the rents may be way under what they're supposed to be. So if you're looking at the 1% rule, you'll say, oh, this one doesn't work. And maybe the rents are like, really low. The people live there 10 years and they never raise the rent. And that's the opportunity. But if you only use that rule, you wouldn't notice.
Right, or maybe the property could there's ways you can add value to the property, finish off a room, add a bedroom, add a bathroom, raise the rent, and then looking at the original numbers doesn't make any sense because the value in that one is the additional equity that you can bring to the deal, as well as the increase in rents.
So I'm curious too, you obviously work with lots of investors. What do you think is in store for 2021?
So I try not to predict the market in general and just do the best you can no matter what happens, right? And so be prepared for a crash or be prepared for things to go very well. With that being said, I don't really see any, it doesn't seem like we're in a bubble that would pop. I think we could see stock market volatility with real estate. I think I don't see it slowing down anytime soon. Construction costs are expected to be high. The demand is very high. There's been pent up demand even with lack of inventory. So there's yeah, I don't think there's a real great answer, but I don't think it'll do anything bad, but we're being prepared for it to do something bad.
I like that you said that, Scott, because being prepared, I can sleep better at night knowing I have a financial plan. I just feel like I'm prepared. What if at least I'm prepared? I'm a Girl Scout. That must be why, be prepared. That's what they taught us.
Right, and it's hope for the best, but plan for the worst. And so don't take all your money out and put it under your mattress, but don't go buy some crazy options strategy and put all of your money in one thing. It's just to be smart about long-term investing.
Okay, I'm going to share screen here for a moment, and then Jeannie, if you can put it in the chat, please. This is how you're going to contact Scott. If anybody wants to know how to contact him, he's right here, Scott Jensen. I've got his email, scott@renovatefp.com, and his phone number, 612-438-2737. So that's how you can find him to chat and figure out your financial plan. And I also have for you, I always offer a free strategy session for me if you want to talk about buy, sell, or invest real estate or the proven profit formula. And actually, if you go to my webpage, LeAnnRiley.com, there's a bunch of buttons there you can push to get strategy sessions. So I'm going back to, okay. There we go. I'm back to Scott and I. Is there any last question here? Good, you got your information down there. And good, Craig, you put your information. He's the cost segregation guy. If anybody needs that, that saves you money on taxes, has to do with, he can even do it on a duplex, just so you know. I never knew that till I interviewed him. So we're all about that. So I just want to thank you, Scott, for sharing with us some of these details and helping answer the questions, and just happy to know that there's someone who's real estate and financial planning. It makes a difference.
Thanks for having me on. This was a lot of fun.
All right. So join us, you guys. We're always the second Wednesday of every month. I'm going to interview somebody that can help you on your real estate investing journey. So perfect timing on the button. We'll see you soon, Scott.
Thank you.
All right. Bye-bye.